felt it would give us the best access to the strongest possible group of senior insurance decision makers.
Insurtech Insights is a must-do conference, I think, for the network that is built here.
This panel is Margin in Crosshair. We are going to unpick the cost pressures which are changing the nature of P&C insurance, and we have some really heavy-hitting people who are on the panel with me. And it's going to be a very interesting session. Why don't we start with Dan introducing yourself? Dan, go ahead.
Hi, Dan Woods, CEO of Socotra and founder.
Yep, hello, I'm Lance Ondrej. I'm with Germania Insurance. I am the Chief Claims Officer, also have some operational excellence responsibilities, been in the industry for almost 30 years.
And I'm Kyle Nakatsuji. I am co-founder and CEO of Clearcover, which is an AI native personal auto carrier, and also the co-founder and CEO of Dearborn Labs, which is the technology team and assets that were recently spun out of Clearcover into an AI services business.
Okay, so let's start with the first question. Lance, what is the cost pressure that is keeping you up?
The cost pressure that's keeping me up, wow, that's a good one. There are many, but I think the ones that are the most concerning and are the ongoing pressures that we see from a hard market on the property side and then the soft market on the auto side. It's one of those situations where efficiencies are really going to drive expense ratios and the ability to compete in the future. And trying to get there sooner than later is becoming table stakes, and I believe is so important in order to be successful. That in light of reinventing ourselves at times. I'm based out of the Texas area, so very heavy in storm activity, which is real. And with that in mind, it's really taking a closer look at exposure management, as well as innovating rating and how we do that.
And Kyle, same for you. What is the cost line keeping you up?
At the insurance business, the cost line that we spend the most time paying attention to, frankly, is the fixed expense ratio, because we spent so much time and energy investing in technology that you need a certain amount of scale for that to make sense. On the variable side, which I think is what we're here to talk about, the business has performed incredibly because we spent all that time and energy investing in technology. So if you look at what it costs us on average to service a policy versus the industry average, it's very compelling. What it costs us in terms of how many features a claims rep can handle and how that translates to LAE, very compelling. So the variable cost side is very strong. And on the loss side, the business is pretty healthy, but if you would have asked me that question 18 months ago, I would have given you a different answer on the loss side.
And Dan, for you and your clients, what kind of cost pressure are you seeing from your clients? Since we're focusing on P&C, otherwise I would have asked about your own business.
Yeah, well, we have quite a few life clients as well. Obviously, we're focused around the IT side, and the cost pressures we're seeing is it's the mounting maintenance cost and the cost of getting anything done at all with the monolithic legacy systems that pretty much every insurer that's been around for more than 10 minutes has at this point. And those costs they've always been high, but right now AI and newer technologies have made it so they can be so much lower. And we're seeing such a disparity between where they're running at in terms of the cost of getting anything done, even simple changes. I'm in 38 states with this product. I just want to launch the 39th state. That cost and the time it takes, and what any engineer today knows it really should take.
So, Carl, the first question for you is combined ratios above 100% are no longer exceptional in certain lines of business. As a digital-first carrier, how is Clearcover navigating the gap between premium growth and loss cost inflation while also trying to scale?
Yeah, I mean, I think combined ratios over 100 being exceptional, we probably took the wrong way for a while. We probably used the wrong definition of exceptional. So like we were figuring that out ourselves. But I think navigating the balance of growth and profitability is always a big challenge in any line of business. Auto in particular, where the margins are so thin. And the way that we used to describe this is it's like a string that you pull on either side. And you can pull it hard in any given direction, and it's going to take the other side with it. So if you are really, really focused on underlying profitability in this business, it is almost a virtual certainty you will not grow as fast as you would like to, or as the people who are less focused on it. Because as you know, this is a room of people who know the industry. But being the smartest person in the room doesn't always translate to growth. Because oftentimes being the smartest person in the room means you're actually just going to charge more for a risk than somebody else is going to charge for that risk, and they will win it. And so like this idea of like, you know, I want to grow really fast and be profitable at the same time, there's probably only one company who's figured out how to do that consistently, and it shows. Progressive is progressive. But for the rest of us, like this balancing act of this pulling the string, sort of trying to land it in the middle, is important. And if you try just like a real piece of string, if you try too hard and you pull on both sides at the same time, it just breaks. It doesn't work. So it is about keeping it in balance. And then now to Dan's point, there's this new element involved in that the cost pressures of today are not the cost pressures of tomorrow. With the advent of AI, and you look around the room. By the way, this is the lesson for all of us. We did not put AI in the title. And if we had, as like a fundraiser, there would have been a bigger crowd. So kudos to all of you for showing up to like the only panel in the show that didn't have AI in it. But I promise we'll get to it. But I do think that you have to be cognizant of cost pressures are coming from places they have never came from before. And that the world of where they come from is changing faster than ever. And so like having an eye towards not just what's keeping me up today, what cost pressures I deal with today, but what is going to be a cost pressure when my competition does the thing that I'm not willing to do, and suddenly it takes them half as many people to run their claims organization as it does me, and that becomes a real cost pressure that it will sneak up on you faster than you think it will, given how quickly the world is moving.
Lance, what does cost containment look like at claims ops level? You have social inflation, you have legal system abuse, and you have rising repair costs. How do you balance all of these? What do you focus first on?
Yeah, first I'd like to just mention to Kyle, I agree with you. That's really going to be I think the defining moment for insurance companies into the future. These next 2 years are going to be so pivotal in order to be able to compete moving forward. To your question, so I want to take a look at like what my company went through in 23 and 24. And most of the industry had a rough 23 and 24. Glad to have that behind us. But it's very unusual in the sense that we saw three things converge. I'm not going to say the perfect storm, but we have unprecedented increases in reinsurance cost. Inflation was through the roof. You know, pick your topic, be it materials, labor, social inflation. And then you had a very active storm season. In the case of the Southwest and Midwest, maybe one of the worst ever. And so that's a lot to focus on at once. Combining that with the fact that never really experienced all three of those challenges at the same time, the playbook that most carriers, including mine, had in place was stretched very thin, and that string popped. And so it was one of those situations where, you know, we were playing rate catch-up. And I'll start there. That was the one area of cost containment, in that we had to figure out a different way to approach rates until we could get in front of it. And I think the thing that we learned as an organization is claims can take their view on severity and frequency. Underwriting can have their view, actuarial can have theirs. But when you're in a period of time like that, and now moving forward, it's extremely important for those three departments to work very closely with one another. because each has data sets that are important in developing that 360-degree point of view. And with that better view, you can more clearly identify leading indicators that people believe in, and you can take those rate adjustments, be it up or down, sooner than maybe you otherwise would have in the past. And it's just a different mindset. Same way with really working on loss control efforts and taking advantage of new tools. And then last but not least, cost containment efforts are really to capitalize and make sure that you're getting the full ROI out of the products that you already have. Sometimes carriers forget that. They get carried away chasing shiny objects. Next thing you know, you never did fully capitalize on the ROI from the tools that you have integrated. So those are just a few thoughts.
So that's a lot. Let's come to the IT side of it, Dan, because you're very au fait with that. So carriers, CTOs are being told to modernize their core systems and also control IT spend. And then the CEOs are asking them to put AI into everything because that drives up the share value. How are people navigating this in your experience?
See if I understand the question right. You're talking about having pressure to reduce spend and pressure to modernize technology. Why are those opposites? If your modernization is now resulting in lower spend, something right now, you might have made a case a few years ago.
Yeah.
Oh, it's a big project to move our legacy thing to cloud, and most people just kind of like heaved it over the fence on AWS and called it a day. But with limited benefit, perhaps, now you don't have a physical server. But the current technology revolution is AI, which has enormous cost savings. And embracing it, doing more of it, should lower your costs, not raise it. Of course, you can do anything wrong and make it cost more money. I mean, happy to talk to anyone who wants to, happy to collaborate with anyone making a plan on what this looks like for modernizing core. But the costs of maintaining and working with a monolithic legacy core are so high that moving to something modern is a cost savings exercise, no matter how you do it. I mean, I'm sorry, you can mess up anything. I should stay with that. But it's come so far. Just do a pretty good job of it. You're going to see some significant savings. You just need to make sure the thing you're upgrading to is actually modern, not just having good marketing. It's got to be really AI friendly. It's got to be productized. Ask questions like, how many other carriers are on this exact version? Things like that.
So let me give you the example, since I have sat in the executive committee where spends are being discussed. Spends are capped at the GWP percentage for technology for some arcane reasons. And modernization of core systems are multi-million-dollar, multi-year, high-risk investments for the XCOM where I sat. With that, now the CTOs are being asked that AI, where recently we heard some software vendor having blown through $500 million of their budget in 4 months' time, has FinOps really worried. And also the sprawl, the IT sprawl with all of the little models people are running on the side as shadow IT. The costs are escalating with the soft market that we talked about.
I mean, you can mismanage anything, but we've seen that AI has lowered our development costs to by about 75% for deployment. Now, granted, that's because we're working with a modern platform, working with legacy, it's going to be less. But if you're making proper and safe use of AI for your IT work, there's your savings right there to do a couple other projects. I'd also say that if you have any product migration to a new system that's still running after 2 years, take a good hard look, and if it's 3 years, just stop. If it's a big deployment, it's a big rollout, and it's going on for 5 years, just stop. The thing that you're moving to is no longer modern, sorry, you've got a sunk cost, but that'll save you a ton of money right there. And then you're going to find something where you could literally start from zero and get it done with a budget less than whatever was remaining in that thing. The physics, the calculus of IT projects has changed significantly. Now, I'm not one of these people who thinks like everything, AI can just do everything, it's just a matter of tokens. I actually published a paper on this recently on our website on how to do proper, safe AI-assisted coding. It sounds, Kyle, like you're getting a lot of experience with that as well. And you're seeing, I'm sure you're seeing the same multiples in how much stuff can get done if the folks know what they're doing, but they have to think very, very differently. You cannot bring the old mentalities in, and we all know that. That's why every other booth has a .ai on it. Things are really changing.
What I would add to that, I agree. What I would add to that is moving into AI, moving to a modern software platform should save you money. But what I find, and we just, we launched a business that does consulting and services in this area, and we saw it in our own business, which is why we did it. The difference between could or should save you money and does save you money often comes down to actually figuring out the inputs in your business that are driving the cost. So like AI will make a process more efficient. Great. What costs money in a process? Processes in and of themselves don't cost money. People who execute processes cost money. Systems you pay for, data you pay for, they're like components, inputs to the system that comprise the process that actually cost you money. And if you do not change those inputs, but you add AI, you have spent more money, not less. And that's where like people don't, they bolt the AI onto some existing process that they don't want to change because change management is hard, or they can't spend the money on that, and they get no return. And if you look, like we're not making this up, like what you're starting to see come out of this AI revolution most recently, Bain just put out some numbers like last week, nobody's seen any cost savings. We spent a lot of money, right? Very few people are reporting real cost savings from it, and in part because the technology should save you money. AI should improve the process, but if you do not take the steps to actually remove the cost from the business that is driving the cost in it pre-AI, you don't save any money. So one is like that you have to take those operational, workflow-oriented, sort of cost-centric input steps to make this work.
We're having cost savings.
Yeah.
Okay.
I mean, how big of a team it would have cost to get done the stuff we've shipped in the last year?
If you're building, engineers are going to put out more product. But in insurance business,
I'm talking about the IT
claims organization, you run a claims org, right? Like your LE's not going down.
I'm talking.
Right, we'll stick to PNC insurance. Dan, you're talking for your clients here.
And I'll add just real quickly before we move on. I guess I'm in between you guys for a reason because both of your organizations are much further ahead. I find ourselves and our senior management team is sort of split in their way of thinking to the points that you made. You clearly see the vision out there. We have to begin to think that way and sort of loosen the reins around the old way of thinking in the legacy environment, truly understanding what it is to be an AI native environment and what that means in the future is just different than a legacy-based product.
Okay, so we're going to move to the next section, which is data, AI, and better decisions. Lance, let me start with you. Data aggregation from providers like LexisNexis and HazardHub keeps coming up as a priority. In practice, how do you get genuine value from that aggregation rather than just adding cost and complexity to the decision?
Yeah, I think the challenge we've probably all faced is we're very hungry for data, whether we're purchasing it or we're mining it ourselves in a data lake. And so you have all of this data from an insurance claim standpoint, and it's similar to an underwriting as well. We have these data points flowing into the file, some of which we buy, some of which we get from agents, some of which we get from customers. You have estimates, you have photographs, statements, all of these things. Some of the earlier AI agentic tools was all about summarization. What I see as really being the key in the future is to layer an AI tool on top of the core system, assuming you have to live with it for a while, and basically synthesize that data to a degree that a person is not going to be able to do on their own. either due to time constraints or inconsistency in their competency level or their training level. It's so key. The power of that data is greater than any one data point and its merit. So let's say you're using a provider to purchase a fraud score, or you're using a provider to purchase a risk-related score. And you've got all of this data. It's like each one of those give you certain intel. But collectively, if they're aggregated and synthesized, what does all of that data truly tell you? And if AI is able to do that at 60 to 70% times from a speed standpoint and from an accuracy standpoint, just think about what your technicians can do once they pick up the claim file or an underwriting submission and have that data available to make critical decisions around. I think that's key, and it's the same thing when you look at it at an enterprise level, is really being able to capitalize on data through all of the silos or departments in the company. What does that tell you? What will that do to transform your strategic plan moving forward than if we operate in silos and we're thinking more at a department level?
So
Insurance, by the way, insurance and data has an underwear gnomes problem.
what problem?
Underwear gnomes? Anybody know what an underwear gnomes problem is? You'll have phones. Look it up. It's a South Park episode.
Okay, 25 years in the sector.
So the underwear gnomes have this great plan, right? They're going to collect underwear.
Yeah.
And then step 2 is a question mark, and step 3 is profit. Right? And that data and insurance have always had an underwear gnomes problem, which is like, if I just get the data, then I'll be so much better. And you need to figure out step 2. And now, what AI does is it gives you a pretty interesting option for step 2. You mentioned earlier this like contextual substrate that says, look, like what we do in the old version of insurance, like the underwriter and the salesperson and the claims person, they get in a room and they have some sort of regular occurrence of meetings where they talk about what's going on. Because if you loss ratio problem, I'm trying to predict I'm going to have a loss ratio problem. What are you going to look at? Well, I look at frequency. If I have a frequency problem, that's going to cause that, but that's not soon enough. I'm not moving quickly enough. So let me look at bound mix. Am I getting something in that I wasn't getting in before, and that's the cause of what's going to, okay, great. But you know what's even better than bound mix? What is binding at a higher rate than it used to be? And you know who knows that? Your distribution guy knows that, but he thinks it's a win. And so like this notion of getting those 3 people in the room and saying that thing you think is a good thing is actually a bad thing, but only the claims guy knows it, used to be kind of hard to do. With AI and the right contextual substrate, that can happen continuously. And so that is like, now you have this a smaller underwear gnomes problem because the data can actually be useful if you build the right step 2. And the right step 2 to me feels like this contextual substrate that allows you to really draw inferences from data that wouldn't actually be all that valuable on a standalone basis or in and of itself until it's mixed with this other information, and you can do so in a much more rapid fashion.
It does bring up the question whether it's boxers or briefs, but anyway.
Yeah, I think the underwear gnomes took all of it.
You're right about that step 2, the question mark, but there's also a question mark on, like, frankly, step 0. Like, okay, you could say, do something and suddenly I have all my data. What does that mean? Like I hand you a hard drive? Like what is that? Like the idea of like, okay, so you're plugged into a modern infrastructure like a Snowflake or Databricks. How does that just happen? Does it connect to the whole thing? Is it actually real time? Are you doing midnight batch jobs in your company? Can you actually query this thing? There's like a ton of infrastructure that it's just sketching on a napkin. I want to take this data combined with this thing, whatever is so far from actually something that's actionable so you can even get your underpants data that there's a step 0 that people just kind of assume, and it's not trivial.
Okay, so we'll move on from the underpants themes. AI is being positioned as a major driver of efficiency in insurance operation, Dan. So in your experience across carriers, where is it genuinely delivering value today, and where is it still an aspiration versus the reality?
Yeah, so there's so many places where AI has created value, is creating value, will create value, and they're different. The lowest hanging fruit is using it to help with IT and development, and the lowest of the lowest hanging fruit is prototyping. That's why everyone's loving that. So that's a great place for some quick wins, prototyping things, proof of concept, stuff like that. then there's the wall you hit when you actually want to bring it into reality. And it's not like that wall is any higher, it's just so disproportionately high with how incredibly easy it was to create that prototype that suddenly it feels like it's harder than it used to be. It's no harder than it used to be, it's actually easier. We're seeing a lot of insurers doing things on the periphery. Just last night at our event, we had a panelist from running a major business unit at a tier 1 who said he just had the call center summarize calls and just create the summary. It's just the simplest thing, and I'm sure there's a ton of different companies that could do it. And he's like, it didn't create a ton of value, but it created some, because it turns out they hate typing up notes after a meeting, but culturally, it got them used to the idea of using, it got them comfortable with AI with a small win. So we're seeing a lot of those on the periphery. Now, and there's a lot of startups popping up to help with things on the periphery. The two areas of startups we're seeing a lot of is periphery technologies and consultants. A lot of the consultants are talking like they're product companies, but they're really consultants. Those are the two that we're seeing a lot of, and those are going to get insurers to a point. And that point is maybe 20% of the benefit of what AI is going to be able to provide. Because, like I was talking about data, can you actually get to that data in real time? Do you have an event stream that actually pushes? Are you able to synchronize it with a Snowflake or Databricks real time? Is it able to receive updates? So when you actually use your assistant within your operations portal, can it receive updates and keep getting smarter, or is it just have you just bought another fossil that happens to say AI on it? Because this stuff is moving so fast, it's going to fossilize so fast. So that is going to require rethinking core, which is of course the problem we at Socotra think about day and night and have been doing for our 50 customers. So that's kind of where I think things are going. They're going to hit a limit, and they're going to have to think about their core.
So if you have any questions, please do drop them on Slido, and I'll read them out. The next section, we are on operating model and expense ratios. Lance, expense ratio is a persistent problem. For context, insurance expense ratios have been stuck at 32, 33, 36%. This is traditional insurers. And for more digital insurers like the ones in Europe, Trug, if you're Danish, it's 16 to 17%. Massive delta. And when we think of the size of the price, but the cost of implementation and the complexity of deploying it, how do you make this equation work? How do you make that short-term pain more bearable so that we can have long-term benefits from that implementation?
Yes, so I think it's critical to make sure you understand where your board lies with this. Fortunately, our board is, I would say, very eager to innovate through AI to the point to where we even get more support than what we had anticipated to make that upfront investment despite the expenditures on products that we're already using. Now, that said, we're still challenged with attempting to balance that, and it is difficult. I agree with where Dan was coming from. It's like, gosh, can't you see the forest for the trees? Once you get there, it's going to be so great. And yeah, you may have to pony up at first, but once you get into a better state, you're going to be able to do more faster. And you're going to be able to continue to innovate faster. I think we all see that, but then you have the complexity of all the long-term contracts that you're in that you mentioned earlier. And so one of the things that we did was strategically look at each of the contracts that we have with our providers. So rank ordering our service providers, in particular those SaaS-based solutions that we have integrated, rank ordering them to determine, put them in 3 tiers. The ones you still have to have, those that are nice to have, and those that you look at and go, huh. So it's one of those situations where those that are truly adding value, what can you do to renegotiate those agreements? Whether it's at the end of the contract term, Do you go to those providers during midterm, renegotiate, maybe restructure the contract? Some may be willing, others may not. If you're buying more solutions from them, they're willing to do it. And then, last but not least, just draw the line in the sand. Yeah, hey, we've been paying you a lot of money for a lot of years. We're down now. What can you do for us? So that's one approach. The other approach is when you look at the solutions that are at the bottom of the list, we're beginning to find out, it's like what that solution does, I could build an in-house tool through a large language model to do the exact same thing and be done with it once it's developed. So that's one approach to take, and or if you see that it really has limited value moving forward, it's like what AI native solution is available out there that not only could replace the functionality of that particular tool, but do even more. And that's where you start to get that lift and see the benefit much faster. So that's the way we're trying to think about it. It's not easier said than done. Fortunately, I'm in the position where we're willing to make that investment because of what I mentioned earlier. We believe over the next couple of years, this really becomes table stakes. We're up against folks like this gentleman who's already in a nicer environment than some of the legacy states that the rest of us are in, and getting better expense ratios. So to compete in the future, got to do it.
Okay. Kyle, my question to you is on social inflation and litigation. That's really driving up the loss costs. If you were considering being, I don't know if you're a multi-line already, how would you decide which lines of businesses you should be in given the environment is really deteriorating?
Well, it's an interesting question because we're not. We just write personal auto. I think the social inflation issue is a bigger problem for people who have been writing in that line for a while and weren't priced for it. So if you were launching a new line of business, like if you asked me, like go into a line of business where you're not going to be at risk of doing this, it wouldn't necessarily be the ones that hadn't suffered from social inflation. It might actually be the ones that did. And now the rate environment is very healthy, and we think that what was driving it has started to taper off, and so you feel a bit better about entering at that point. Like whether or not your rates are adequate is a function of the tail in that line of business that you are writing and the adequacy you enter with. And so like for auto, like we write a bunch of non-standard auto, and we just launched a new product in Florida. And Florida is very healthy right now because tort reform went through in Florida and it did what it was supposed to do, and loss ratios in Florida are very healthy, and we were very glad to enter when we did. Now it's competitive as all get out because everybody saw it and everybody wants to write in Florida. But if you would have asked about social inflation and litigation costs in like 3 or 4 years ago, Florida is absolutely the wrong place to enter. So it is, I think it is a question of timing, but I think what people get wrong is they get like the temporal view wrong, where they say like, where do I want to be based on what's happening today? And they forget to take into account that the claims, depending on the tail in that line of business you choose, the claims aren't going to come in for X to Y, and you need to start thinking about what that social inflation or loss cost picture generally looks like when the claims actually start rolling in that line of business.
So would you say you take secular view of the data rather than taking cyclical view and say that we're going to stick to it because on a secular basis, this line of business will remain profitable because we've priced adequately. We know the tail, and we know the liabilities that can be generated from that.
Yeah, to the extent you can actually do that. Like the talk of the town right now is AI liability insurance.
Yes.
Right, and so like I don't know that anybody's got a very clear picture of what the tail and the actual exposure looks like in AI. Now some people are going to sell it, and we'll see how they do. But like. There are some where like no matter what view you take, you're sort of rolling the dice a bit. But yes, I think generally speaking, you look at them on a line by line. And really, what you want to do is, like any analysis, say, I need to get into the input layer of this and say, when is a claim going to come in, and what do I expect the loss pressures are going to be at that point when I start receiving those claims.
I'm going to ask you about reskilling. It's because the kind of skills that your team already has are the ones that P&C insurers want as we move towards the AI future. Where do you think that carriers could be looking at in terms of skills? What kind of skill sets would you want the carriers to start inculcating in their workforce? Or are you primarily focusing on process rehauling?
Well, I mean, skill and process are two sides of the same coin. You create the process, the person needs to have the skill to execute it. And obviously this question is going to come down to AI, because what else has changed drastically in insurance in the last 3 years at this rate in terms of skills and skills that are necessary? The example that I gave from one of our clients, just adding the summarization feature, for example, that in a way that didn't create a new skill, but it did create a new culture. And it got people used to the idea of like, okay, AI is here. But something that's also, there's also a darker reason why it's important for your employees to have AI skills. Because humans don't like doing more work than they have to, and they're going to use AI either way. And you're going to find a way for them to do it safely, and you're going to give them that way to do it safely, or they're going to find another way to do it. And I think of kind of like it's like Napster and Spotify. What killed Napster? It wasn't the recording industry. They couldn't stop it. What stopped Napster was it being easier to get the same thing pretty cheaply through another service. And it became easier and better, and then people went voluntarily to Pandora and Spotify and whatever else. So you need to find those channels, and you need to create them, obviously train those people who aren't doing it naturally, because people are all over the place. Some people are afraid of it, haven't touched it. Some people are like, they're going rogue. And somehow you need to pull these together and have them first learn from each other, reward the people somehow who are doing more of it, and give them a way to do it positively, and then make that work throughout the organization, back and forth. And what we've done is just every 2 weeks, mandatory, company-wide, we're doing some kind of an AI training. This week we're going to talk about prompts. We're going to do Notebook LM or whatever it is, and we treat it as a high priority. And we tell people like, yeah, we're making this mandatory, but you should want to be here. Everyone wants to learn this stuff. Certainly anyone who's employed at a technology company or attends a technology conference. So that's something that we've done. You could scale for an insurer.
That was quite comprehensive. Thank you. Lance, I have an audience question for you. How do you see the contextual... Ooh, it's gone? It's disappeared. How do you... let's see if it appears here. Yeah. How do you see the contextual substrate, which is a term you use, sitting next to Guidewire? Wouldn't Guidewire just give it to you? What does that mean? Whose question is this? Can you ask the question?
Someone that knows
How does
where God.
Well, it goes back to the step zero. Legacy doesn't just hand over data. Like, what does it mean? Like, do they actually have a data stream? Do they actually integrate with, a data lake and things like that?
It's a challenge. I mean, what we're trying to solve for is really, it gets back to what were the use cases that some of these legacy tools were attempting to solve, and how were they created? And they weren't necessarily created with a bigger end game in mind. They were created to solve a particular use case, and that was the extent of it. Being able to use all of the outputs and the information that's in the core system is, whether or not some of these providers will ever get there, I'm not sure. What we're learning very quickly is adding AI to a legacy-based SaaS type of environment is adding AI features. It's not adding AI native in an environment that's going to take you into the future and really push the envelope forward. So it's really trying to solve for that. I'm real cautious in looking at adding additional AI tools. If I know that there are better tools on the market through third-party providers or through consultants or whoever.
To Lance's point, I know we're out of time, and Dan mentioned this too, the data lives everywhere. That becomes the real issue. We ran an exercise at Clearcover where we did like an internal discovery project on automating underwriting. And what we found out is that there were roughly 800 separate private direct message threads on Slack where the actual process lived. We had a ton of process documentation, but the real decisions got made in these 800 individual direct message threads. And unless you can weave that into the thing that is collecting context in your business, you do not know how decisions are getting made. And so this that contextual substrate has to sit on top of a lot of stuff, not just your admin system, not just your claim system.
Okay, so final question. Each of you have a combined ratio target for this year. And if you don't meet it in 12 months' time, what is the first cost lever you would pull? What's the first thing you will slash and burn?
Are you asking me or my board? It might be me.
Okay. Are you that expensive? Would you have made a difference in your combined ratio?
No, sadly, not enough. Not for anybody's liking. I'll go first. The first thing that would go is growth, because I think that is a lever that costs money, and if you have to save money, that is where we'd go first.
Okay, Klaus.
I concur with that as well. Growth is important, especially coming off of a couple of very rough years and where we went backwards in count. We're very disciplined at this point to grow, but not at the expense of surplus and profits. We have a future. We know what our 4-year plan looks like now. We're going to be very disciplined in taking that approach. Going back to the questions earlier or the comments earlier, what we've learned through all of this, if we pitch out the baby with the bathwater, eventually we'll find ourselves in the same place again. And we have to be more disciplined than that.
And what would you advise, Dan?
I think for any insurer I've encountered that's tier 2 and up, they have at least 1 and probably 3 migration projects happening somewhere that is migrating off of legacy and onto legacy. Kill those projects.
Okay, so we're shrinking to greatness like all insurers. Thank you very much for your time and enjoy the rest of the conference, please.